Happy Friday and welcome back to Stock Market Weekly, episode 699, presented by The Trade Risk. My name is Evan, and here's what I got for you in this week's episode. Big story front and center is the range expansion lower for stocks. And if you tuned in last week, hopefully you weren't taken for surprise. We talked about, as the number one sort of topic of last week, was the back-to-back inside weeks and that volatility compression that typically leads to vol expansion. We did get that expansion this week. We of course didn't know what direction it was going to come, but it came lower, as we can now see in hindsight. We're going to talk a lot more about that in just a moment. Yields at the same time breaking out to new cycle highs. They were getting close. They were inching up last week, and now we finally got that push back up to new cycle highs. 10 weeks straight of US dollar gains. Kind of goes hand in hand here. Very impressive run here for the US dollar. Certainly a little bit stretched and overbought at this point, but it's marching higher. Every sector closed in the red, and we've got the government shutdown, which is a new kind of fear that everyone is now talking about here. Don't want to totally downplay it as it being inconsequential, but we've seen a lot of government shutdowns and in recent past, and it isn't usually the end of the world, but we can talk more about that a little bit later. So stay tuned as we get into all of this and some more in just a second. All right, we're back. We've got some charts in front of us. We're looking at Warden TC2000. And for you TC2000 users, as a reminder, check out our website. We've got plenty of custom stock scans, custom indicators, layouts, all kinds of things to help you get more out of this platform, and custom stock scans. I spend a lot of my time writing code for traders looking for specific patterns, pullbacks, breakouts, momentum setups. If you got any of that you're looking for, check out thetraderist.com and the Warden TC2000 link at the top of the navigation. Now let's get into it here with the numbers. Follow my mouse up here. 1 week returns red across the board and pretty deeply red. Dow Jones was the best house in the neighborhood, down 2%. S&P down almost 3%. Nasdaq over 3%. Russell down almost 4%. Take a look at the 1 month returns here. Everything is now firmly in the red and continues to pull back. If we take a look at our volatility indices here, Nasdaq vol back over 2022, one of the highest we've seen in quite some time, up 3 points this week. And the VIX for the S&P 500 at 17, still a teenager here, but still up 3.5 points this week. Let's take a look at sectors, because everything was a loser this week. Everything in the red here. Healthcare, utilities, consumer staples, very defensive tone. They were the best performers, or the relative strength of the bunch here, but they were still down 1.5 to almost 3% on the week. It was discretionary, real estate, and materials. They were the hardest hit this week, 4 to 6%. And you can see again on the 1 week returns, just about everything here is in the red now. It's just energy that's trying to buck the trend, and utilities almost flat over the past 1 month. If we take a look at those sector trends, definitely have some new developments here, because if we look at our smart trend filter, so this is a custom indicator that maps and measures price and volume across time, you can see that almost every sector now has transitioned into our red sell state, with only energy still hanging out in kind of that yellow transition spot. And same thing with utilities, is still managing to hold on to the yellow sort of transition dot there as well. But everything else produced a sell signal this week or earlier or late last week. So definitely, in terms of market breadth and just sector participation, you can certainly see things spilling over. Now, if we get a little bit further into market breadth here, this is an interesting development, because as folks that have been tuning into our videos have heard us talking about here, the ratio of 52-week highs versus lows, as we've been mentioning, there have been more stocks dominating the 52-week lows list, but we weren't getting any type of expansion, right? We were just getting the stagnation of, more stocks making lows, but the ratio wasn't really, increasing one way or the other. until this week, until we finally got a big spike here. So if you look at Thursday's action here, we had 790 stocks make 52-week lows. That's a pretty big spike. You'd have to go back basically into almost last year or the year before to get spikes that far up. We had a couple in March, I should say, that were close, but this one started to, I believe, at least on this ratio, take the cake here for the largest surge in stocks making 52-week lows. So we're going to need to see if that continues up. Clearly bearish evidence, though, spilling over this week. You can see our ratios, right? Percentage of stocks over 200 SMA down to 36%. Same thing with the 50 SMA. 87% stocks in the S&P 500 were down this week. 79% in the Russell were down this week. So all's to say, market breadth really sort of confirming or spilling over here as markets pulled back this week. Now, if we take a look at IBD stocks, you can see definitely things hit pretty hard here. Actually, not sure if this list got updated, but IBD is a sponsor of the show. They help make the show possible. So shout out to them for sponsoring the show. And it's actually MarketSmith free week here. So you can get access. See if I can pull something up real quick on the fly. Wasn't the best prepared for this. MarketSmith charting software, which we're not looking at here, but it is still very powerful. And I do use it for our weekly Trade Risk 150 list and a couple of other things. You can get access for free. So just drop your email in. I'll put a link in the description of this video, and you can take advantage of this offer. It's usually pretty pricey, so why don't you take it for a test spin this week, see if you can do some homework before the trial runs out. We'll put a link in the description of this video. Thanks to IBD for sponsoring the show, and let's get on to it here with commodities. You can see silver at the top of the list, 2% to the upside. Dollar index, again, continuing its path higher here for another consecutive week of gains. Gold managed to stay up just a smidge. Oil finally a little bit on the downside here. It's been on a heck of a run, but it was down almost 1%. Natural gas down 1.5%. Ag was down 2.15%. Pretty big move there. And copper down as well this week. Big story, though, was interest rates, were yields. They were breaking out to new 52, or not 52-week highs, but more like decade plus highs, 15-year highs for this cycle for new highs here in yields really across the maturity, all the way down 5, 10, 15 plus for interest rates moving up. New cycle highs. This has been really the risk that we've been talking about, and really the most consistent risk here has always, in my eyes, been just accelerating yields to the upside here, and we're certainly seeing that continue to take place this week now. Tech stocks, of course, started to correct last week. We started to get heavier correction this week, and I think all of this really plays hand in hand. We had the Fed out, of course, this week with kind of reiterating its hawkish stance, probably, looking for one more rate hike this year. And, market sort of pricing that in and starting to come to a bit of a reality with perhaps higher for longer. Let's get into some of the price action now with the S&P 500, starting here with our trusty old roadmap. And I love just sort of the technical beauty here this week, because again, if you're a technician, this action really just, is clean and orderly, and really, kind of just falls in line perfectly. And it doesn't always happen that way. But really, last week, this is a weekly chart of the S&P 500. We were talking about the back-to-back inside weeks that we had just experienced. We talked about the volatility compression. We talked about the indecision. We talked about the chop and the sideways, bets being placed on both sides of the fence. And we didn't know which direction this was going to tip, but we knew that we should be looking for an expansion up or an expansion down to take us to either the upper end of the range up around 4,600 or the lower end around 4,300. This was essentially the setup we had to get us to one of these lower or upper bounds. And now, of course, in hindsight, we see that the path was lower. We broke down, again, very sort of textbook and orderly. If we go down to a daily chart, it didn't start breaking down on Monday or Tuesday. We had, this sort of, just smaller range day on Monday. We had a louder kind of wider range hammer or doji that got kind of put in here on Tuesday. So we tried to break down, we sort of failed, but this was the day. I mean, Wednesday was the day to take notice. This was Fed day, of course, but we, started up on the session. We tried to probe up a little bit, and then we just completely engulfed the prior day, almost the prior 2 days of action, and closed the day on the lows. And I think this was the day to absolutely take notice and to take cover or to short or to, do your risk management or adjustment on this Wednesday when we engulf that action, and knowing, what the prior 2 weeks looked like, this vol compression, right? This breakdown here was, I think, the spot to sort of take notice. And then, of course, we saw more heavy selling pressure on Thursday, and then on Friday ended up closing towards the lows as well. So that's where we stand now. And as we kind of look ahead here, we're coming right back into this 4,300 zone. And so this level has been on the chart for quite some time. It's been pretty influential in the past, and we're almost there. We did undercut the August lows now, and we are going to be, really spending some time now to see if buyers can step in and support this 4,300 zone. I wouldn't be surprised if we have a little bit more to go to prove on the downside early next week, perhaps another, 1% or so, get us down to the 42 and change area, and see if dip buyers show up and defend this level. I still believe that we're in this range until proven otherwise. So we've now seen a nice move lower. Perhaps if we see another down open on Monday, we start to get more panic out there, more selling, maybe some aggressive shorts that are still pressing or trying to look for more of a breakdown here. But I wouldn't be surprised if, we kind of undercut, reverse, and kind of held the line here somewhere between 4,250 and 4,300. That's just my gut. Again, I'm not making any big, bold predictions or going to go out on a limb and try and hold firm on that. But my gut just says, I wouldn't be surprised to see us get a little bit more to the downside and then quickly reverse, or at least go sideways, kind of frustrate the majority, and generally speaking, kind of stay range bound in this range. That's kind of my thinking here. However, I'm certainly open-minded to the fact that if we come in Monday, gap down, and just furiously see, again, more terrible breath, more expansion in this 52-week lows list, if we continue to see yield spike and we just close at the lows with, just a very nasty looking session here, then I'm definitely open-minded to a bigger correction on the horizon here, and something that is absolutely changing the course of this year-to-date trend. But until and if I see that, I'm going to stay open-minded here. I'm going to look at these levels, 42.80 or so, 42.90, this general zone in here. I'm going to look for that to hold and see if we can find some lower risk opportunity bounce plays at that time. So that's kind of the way I'm looking at things. S&P 500, beautiful technical breakdown, down 3 weeks in a row. Nasdaq 100, pretty much the same thing here. Again, talked about the inside back-to-back weeks, got that nice breakdown, testing the August lows here. Maybe we, undercut this, kind of whoosh down into the 350s, low 350s or so, and then see if buyers kind of step back in and can support this market. And the Russell 2000, finally, you can see that this, again, breaking down this week, heavy, heavier volume, I guess, not quite too heavy. I guess I eat my words a little bit, still below average on the weekly volume, but heavier, kind of range down as we, move back more firmly into a longer almost year and a half range for the Russell 2000. So some pretty bleak action, but we have been selling off pretty aggressively here, especially in the Russell 2000. If you look at this daily chart, I mean, it's just been down for the last, let's see, 16 or 12 bars. We've basically been down 10 of them, 10 out of the last 12 days. So pretty ugly action here out of the Russell 2000. Certainly beaten up and a bit oversold. If you're trying to short here, you might be a little bit late in the short term. So just be cautious. But that's sort of the read there. Let's take a look at some other markets, some other things that we wanted to talk about today. First being, really, just yields again, IEF, right? 10-year treasury bond, you can see rebounded a bit on Friday. You can go to TLT, but both of these markets still just continuing to cycle, to kind of ratchet down, to break their prior lows, and are looking still just pretty heavy in downtrends. Sure, they were pretty extreme. I mean, the move we saw on Thursday here out of yields was very big. Lots of volume came in. So, Could that have been a washout? Sure, could have been. Maybe we'll see it. But right now, there's just too much evidence, too much heaviness here in this downtrend to want to try and pick a bottom here. So a little bit of an oversold reaction higher makes some sense, but I'm going to need a lot more proof to call the end to this downtrend here in bonds. If we take a look at gold, you can see, well, we did have a little bit of choppy action here. You can see we tried to push up, tried to push lower, ended up closing the week almost where we opened. So not much action happening there, but a nice range sort of developing here in this, right under 180 or so for the GLD ETF. So we'll see if buyers can still defend this general area here and make a move back up towards the upside. Oil, notably here, finally had a little bit of a pause. It was down 0.81% this week. You can see it's mostly just going sideways. Some heavier volume earlier in the week. Looks pretty healthy, normal kind of digestion action happening right now. So the chase continues to be on for oil. Nice rally there in the face of a very strong dollar. And speaking of the dollar, you can see now almost 10 straight weeks up, or I believe it was 10 straight weeks up. Very, very impressive. Again, maybe a little bit long in the tooth, but this is certainly where a lot of safety is kind of hiding out right now as we have this government shutdown fear and kind of everything else going into the end of September, a seasonally weak period for stocks. Now, a couple of other things to take a note in the heavyweights. Apple. So we talked about Apple a couple of times here, kind of getting back towards its 4-month lows, looking pretty heavy, hasn't quite broken down, lots of distribution days being racked up here. So this one certainly be interesting to see. Of course, has tremendous weight in some of the mega caps here. It is, kind of oversold a bit. It has taken its lumps. It's about 12%, I believe, from its highs. Yeah, about 12%. So decent little pullback underway here for Apple, but I think really it's this 173 zone here. If we start slicing through there, then that's certainly going to cause a little bit of panic. Now, if we take a look at Nvidia as well, again, big market leader here, it's down 20% from its high. So obviously when it's up a tremendous amount like it is, 20% doesn't really look like a whole lot, but it's a pretty good size, correction from its post earnings highs here, where it was briefly over $500. It's now back closer to $400. So see if there's some dip buyers that want to step in here and support the stock. All right. And so finally, if we wrap up with some sectors and industries of note, as you can imagine, not a whole lot on the upside here populating on these custom scans of ours. You had business equipment, which was really moving this week. Let's see what was moving this. Oh yeah, so this is a pretty small sector and or industry, I should say. Yeah, so it looks like a handful of names really sort of powering this higher, mostly out of VIRC. And then we had lodging also really ripping higher here. So let's take a look at this. Must be, yeah, another small industry here that TC2000 is populating. So there is, what was the big mover this week? Probably this LUXH as a nice mover there, smaller cap stock, buyer beware. And if we go to the downside here, this is where all the action is, a lot more things kind of breaking down in a more notable tone. There's too many here to run through all at once, but you can certainly take pause on this video, take a look here. These are some custom scans just looking at notable volume or notable breakdowns here across sectors and industries. So feel free to dive into these this weekend as if you're looking for some short opportunities or things to stay away from. So that is what I got for this week, ending Friday, September 22nd. Thanks for tuning in. As always, don't forget, we got links in the description of the video. You can get IBD's free MarketSmith weekend for the next 48 hours. So check out that link. You can also check out our website at thetraderist.com to get more scans, indicators, trading systems, all kinds of good stuff if you are in the market for that. So thanks so much. Feel free to leave a comment below. Let me know what you're looking at this weekend. Always like to see and get a sentiment pulse on what folks are looking at. So feel free to leave a comment down at YouTube and have a great weekend. We'll talk to you next Friday. Take care.